Okay, today we're going to be talking about the different credit score there is. Every week, I mean, it's like if I had a nickel for everybody, every time somebody asked me, why is my credit score is different over here than over there, I'd be a lot wealthier person, a lot. Anyway, so I hear it several times a week. I even had an attorney call me like 2 weeks ago. Works for a title company. Owns a title company and wanted to know why this lady's credit scores dropped like 100 points or Credit Karma credit scores because there was really much of a change on compared to her last credit report. Matter of fact, she had paid something off and her credit score dropped 100. So anyway, today we'll go over the different types of credit scores and give you a better understanding about the credit score puzzle. All right, because this big mystery is not taught in the high schools in the U.S., any colleges really that I know of. So we'll try to shed some light on about the different credit scores and how they work and how it's calculated and everything else. All right. So first, let's discuss what a credit score is before we get into the different types of them. So a credit score is nothing but a three-digit number that is used to predict the likelihood of a person that will go into default, in other words. So it's just a risk assessment, number to, whatever lender or whomever is looking at it, so, and that's predicted on if they'll go 90 days or more late and declare, something like bankruptcy. So the credit score is a number that's calculated based on algorithms. So it's a math formula used for the predictive and variety of potential circumstances such as default, bankruptcy, revenue, etc. All right, so it's so funny. I was in DC, like I think in March for a credit event, and FICO was there, and somebody asked the representative of FICO that she had been there for like 28 years or something, said, "Hey, can we get a copy of the FICO credit score algorithm?" She's like, "Well, no. First of all, that's protected, licensed and everything protected. It's just like the secret formula of McDonald's secret formula or whatever. And plus, it's just a math formula, so it would be a stack." She said, a couple feet high, at least a foot high stack of papers with all these formulas on there, and they wouldn't be able to understand it anyway. So, all right, so think of a credit score as a snapshot of your credit report. So it's like, right, when you get that credit score, it's like, right, whatever's reflected on your credit report at that time and whatever's been updated, you have to look at when the account's been updated, then that is determined how what credit score that you have. Information has been added, deleted, updated, and so forth. So let's go on to the different types of credit score. And these are, I'm just naming a few here. I mean, banks and in other insurance companies and all that can create their own credit score. They call it credit score. But it has to go through a federal certification to be called a credit score. But it's still their internal credit score that they wish to use for risk assessment. All right, so let's just go over a few here. So we have the Experian Plus that went from 330 to 830. Experian went through another, like a version called the Experian National Equivalency, which is the newest version. All right, so that's 360 to 850, Equifax 300 to 850. TransUnion has this empirical same model. Vantage Score came along with Vantage Score. Vantage Score is, as you can see below Vantage Score, you have the Vantage 3.0. So it's a new version, the latest version of the Vantage Score, and then which about 10% of the market now. So think of, you know, FICO, as you see on the bottom, is used on about 90% of the market, and Vantage owns 3% of the market. And the three bureaus, Equifax, Experian, TransUnion, got together and created the Vantage score, and then later revised it to the Vantage 3.0. So see, as you notice, the 300 to 850, similar to FICO, which has been around much longer than Vantage. And so they adapted the same score. Of course, FICO got upset, so it's trademarked, but you know, just score, you know, a range. So anyway, so the 3.0 Vantage is what you see on Credit Karma and some of the other places, maybe even like Credit Check, Credit Sesame, which is a free one. There's, you know, quite a few of them. Where you have an affiliate, Identity IQ, they use the Vantage 3.0. So, because it's less expensive to the consumer, because it's a score that was produced by the three credit bureaus. And where are you getting your data from? You get it from the three credit bureaus, right? So, in order to get the FICO credit score, the three credit bureaus or whomever you get the credit report from, data from, has to pay FICO because they're leasing that. So it's like a roundabout, or actually the consumer's paying FICO for that credit score, and you're paying the credit bureau as well, you know, to get the data. So that score is produced that quick based off the data when you pull it, you know. So, you know, that's less money to the credit bureaus directly, and more money to FICO when you get a FICO credit score, because it has to be bought. Now, Discover Card, the credit card Discover, has it for free, a FICO credit score. I think it's through TransUnion. You don't have to be a card member. You just Google like Discover Card free credit score, and you can get your FICO credit score for free. And I think it's actually your TransUnion. All right, so those are some of the different types of credit scores. There's a lot more than that, you know, so we're just going to go over some of the main types. So let's talk about the one that's got 90% of the market. You know, that's, you know, why you're going to talk about something that has only 10% or less, you know, like, you know, Microsoft owns 90% of the market. So most people deal with Windows and Microsoft. All right, so we'll talk about FICO credit score. So it was released in '89, you know, the actual FICO, but FICO, the actual company, was made way back when, you know, before that. So anyway, when they actually came out with the scoring system released out to the public, you know, so that's when it came out '89. Then it started going through revisions, same thing like Microsoft Windows does, you know. So here's the revisions as you've seen. So as you can see, they're due to another revision now. So they did 95, 98, so that's 3 years, right? Then 98 to 2004. So they even went 6 years, but then you notice a trend. Well, then they went to 2008, and wow, these put a little thing. But we just asked FICO when we were up in DC when the new credit scoring system was going to come out, and she says, "Oh, we're looking to update it based off about every 4 years because of consumer spending, consumer habits are changing so rapidly." You know, so it's interesting to see it even longer than that. Anyway, so here's the FICO, some of the FICO scores. You know, we got FICO 05. These are for mortgages. So these are old FICO versions. So if you're looking to buy a home or something, then this is what you're gonna see on your credit scores. You got the FICO 05 with Equifax, FICO 04 with TransUnion, and FICO 2 with Experian. Why do you have these old FICO credit scores that, you know, mortgage lenders are using? Because of Fannie Mae or Freddie Mac. They're the two largest, you know, too big to fail, you know, companies. One's actually, Fannie Mae is actually the government, and Freddie Mac is a private backed by the government, which I have stocks of both. But anyway, so, you know, which is, you know, I'm not a financial advisor, but I would suggest that you look into both of those stocks and look at the history and everything else. So anyway, moving on. Let's see, then you have industry specific FICO credit scores. So here you go to a mortgage, You get your credit scores checked, for a mortgage. They're going to look at those old FICO versions because it's calculated differently when I say the versions. So now if you go to an auto dealership or get an auto loan versus getting a credit card versus getting a personal loan versus an insurance company, you're going to see a bunch of different scores. They're not going to be, the same score necessarily, the FICO credit score, even though it's all FICO credit score because it's industry specific. So think of like you have a car repossession on your credit. So if you have a car repossession on your credit and you go to a mortgage company, your credit scores will probably be higher than that of a trying to get an auto loan, because now they're going to slam your credit scores more because it's auto industry specific and you have a repo hence. Okay, so that's why you have different types of credit scores as well. And so here's some of the different versions. So we have FICO 98, then FICO 2. Hence, as you can see, when they did the revisions in 2000, well, they did 04, FICO 04, FICO 5, FICO 8, FICO 9, and then they had some FICO NG, which she explained to me what that does, but that's hardly nobody ever uses it very much. So FICO 9 is the latest and greatest, really, but not very many retailers or banks or lenders are using that because it's really new. And then you got to think when a lender, let's say you own a big business and you're lending money or whatever, Chase or, one of the big boys or even smaller, so when you're used to a system to do a risk assessment and you're looking at how many loans defaulted and how many loans didn't, are you filtering out the applications, in a better way to have less defaulted clients, so that's what comes into the getting a calculated credit score. So if you have a low default, do you want to change that system and move because there's a newer version? Then you might mess up your ratio and your default. Default might go higher because it's not exactly the same or whatever. So that's the reason why. So a lot of people, car companies are using a lot of the FICO 8 now instead of FICO 9. So here, as you can see, is a nice chart, industry specific. And these are what most of them are using now. Not all of them, because they can use which whenever they want. You don't have to go from Windows XP or to Windows 7 and then Windows 10. You don't have to. You can stay with the old one if you want to. Microsoft won't support it anymore, but you could stay with the old one. It's the same thing as, there's no requirements. It's their money. If they want to lend it, or stay with the older version, they can. So as you can see here, they're using some older versions that can be used by credit card decision makers, so here's the different variations that they can use, so you see mostly the auto dealerships are using, there's the auto dealerships, FICO 8 most, but you can see some of them are using a older model as well right here. All right, and it's the most widely version used is the FICO 8, which is a fairly newer. And some people in the FICO 9 down here. This is the newly reversioned, as you can see here. All right, so FICO 8, what changed with the previous version to what most people are using now? So one of the things that changed is authorized users. All right, so they reduce the benefits because usually if you get added to somebody's account, let's say they have, a credit card they had for 10, 20 years and they got, $5,000, $10,000 limits, almost hardly any balance below 10% of the credit limit of a balance. And then they add you as an authorized user to it, right? Means you're not financially responsible, but you can use that. You're authorized to use that credit card in that account. And that sometimes that will report onto your credit and you get all the benefits as just as it was your account. All right. So they reduced that benefits because people caught on to that, and it's still a loophole in the system that, for the FICO 9, we'll get into that later, but still a loophole in the system where people are selling those. Like, let's say I have one and I say, hey, so and so, you have poor credit. I'm a mortgage broker. I'm going to add you to my credit card to get your loan done. So that'll boost up your credit scores, and or I can get your loan done for you and I can make money, stuff like that. And there's companies out there that find people with these types of credit cards and they sell them up, sell to be added. We have affiliates that do that. I don't get into it personally, but there are companies that do that, and you can be added to somebody else that you don't even know, and to help out your credit to, try to benefit your credit, but it's on a case by case basis. So, don't run out looking for, to be added as an authorized user, because you might not need one. All depends. So they're saying that now in the FICO 8, it's a reduced benefit. Still helps, can help, but not as much as the previous version. All right. So isolated late payments. All right. So many isolated, meaning that you had a late payment. Like, when I say late payment, it's got to be 30 days or more. Okay. So 29 is not a late payment according to the credit side of it. To your lender maybe, but not to the credit side of it. When it hits that 30-day mark, it's going to report a 30-day late, or they can report a 30-day late on your credit to the credit bureau. All right. So that 30-day, 60-day, it goes in 30-day increments. Isolated meaning, let's say you had one in Christmas time. A lot of people, I see a lot of lates during Christmas, January, especially January, February area. But let's say you had late in January, and you had 30-day late, then you were on time for the next 8 months, and then you had another 30-day late, and then you were on time. So that would be isolated late payment. So they're being more forgiving. They're not slamming you as bad if you have late payment spread out like that. High credit card usage, the more impact. This is a big one. I mean, this is the one I see the most, is people using too much of their credit card. Again, remember, it's not real time, so whatever your balance is as of today is not going to necessarily report on your credit. It's when they update the credit card companies update to the credit bureaus, and when they update, whatever your balance is as of that day is what's going to reflect on your credit. So now they're saying it's going to affect your credit score even more. So pertinently, don't use those credit cards. If you do, use it, pay it, be done. Don't use it for a while, every 3-4 months, 5 months. Anyway, that's my suggestion. All right, small balance collection accounts. So they're saying that if you have a collection account that you owe less than $100 on, they're not going to count it into the FICO credit score anymore. They're not going to count it against you. I've seen collection accounts $3, $5, $12. I'm like, oh my God, really? On somebody's credit? And then it doesn't matter that it's $3 or $3,000. It's going to affect the credit scores the same. I mean, it might matter, of course, to the person and maybe to a lender seeing that, but according to the calculation, it doesn't care. It's a collection. So, all right, let's go into the FICO 9 credit scores. All right, so on the FICO 9 credit scores, this is the latest and greatest version. So paid debts no longer count against you. I hear this all the time. Somebody calls me up, well, I paid that collection off. I'm like, yeah, still counts against your credit scores. If it's on your credit report, even though it's paid off and it's derogatory, a defaulted account, it still hurts your credit scores. Now, if you look at it, the more it ages, the older it gets, the less it hurts your credit scores, but you have to look at the report date. FICO says, oh, no, we fixed all the FICO credit score algorithms to not look at that last reported date. I don't know if that's true. I mean, that's what she said. I asked her personally, and that's what she said. I even asked her to the side, and she says, no, no, it's not. It goes by the last reported date, anymore. It goes by when the account went into collections. Because used to, even now, especially with the order credit scoring, somebody looking to buy a home using the order or credit scoring, FICO credit score system, then somebody had a collection on their account with a balance on their credit, right? And it hasn't been updated by the creditor for over 24 months, 2 years, over 2 years. And I tell people, leave it alone, leave it alone. We didn't even try to touch them to try to get it removed because we noticed that a lot of times if they get updated, you try to remove it and then the creditor for some reason decides to update the account or verify and it updates the account, or the person goes and says, oh, let me just pay that off, and they pay it. Of course, now it's got to be updated to a zero balance, and we see the credit scores drop when people do that. So, we have a saying back in Georgia or whatever that let sleeping dogs lie. Meaning, leave it alone if it's instead of open a can of worms or whatever. All right, and so now rental history can report and be a factor of your credit scores. There are sites, and we have a site, not us personally, but I found a site the other day that reports rental history on your credit report now. So you have to register through the site, show them your payments or whatever, and then they can actually report it to the credit bureaus. Interesting, and that affects your credit scores. So let's get a quick breakdown of the credit scoring system. I'm not going to spend a lot of time on this, but it needs to be covered again. I think this is one of the most important things, especially when trying to figure out why your scores are the way they are. And if you know this, you know half the battle anyway. All right, so 35% of your credit score is just paying your bills on time. Okay, so if you're 30 days late, that's part of that 35%. If you're 60 days late, 90 days late, have a defaulted account, that's part of that 35% of your credit score. Okay, just like we said, it shouldn't say just revolving debt. Revolving debt is credit cards. You pay, you use, you pay, you use. That's why it's called revolving. But installments do count as a part of this 30% as well. Just not very much. All right, so think of like 95% is being revolving, and then the installments being the 10 to 5% of this 30%. So again, the sweet spot to have your credit card balances is 1 to 10% of the credit limit. So if you got a credit limit of 1,000, okay, you want it 99 from $1 to $99. That's a sweet spot. That's where FICO says that's like the perfect range. Now, if you have it paid off completely, I mean, okay, so 1 or 2, 3 points difference, no big deal. But that's the sweet spot, 1 to 10%. Remember, when it's reported to the credit bureaus, that's what's going to reflect on the credit report, whatever reflects on the credit report at that time that you get your credit scores. All right, so once you get, the rule of thumb is no more than 30% of the credit limit. All right, so you never want to balance the report over 300, but that's just a rule of thumb. The 1 to 10% is the sweet spot. All right, average age of your credit file. All right, so the longer you have an account open, the better. That's part of the age of your credit file. So this 15% is broken down into different sections. So this 15% is the age of each account. So you opened it 4 years ago and it's still open today. So you got 4 years of history. So whenever you opened it, or to when it's closed, or until, if you still have it open it until now. And so you get, points for those into this 15%. And then also it does an overall age. So when you open a new account, you're lowering your overall age. So just make it real simple. If you have one account that's been open for 10 years, right? And that's all you have, or you have a 10-year-old credit report or history. But if you open another account, just opened it, right? And this one was 10 years, but now your overall age is 5 years because 10 divided by 2 is 5. So now you just drop that. And that's why you don't open new credit just to open new credit because it can actually hurt your credit and you'll get the inquiry, which we'll go over in a minute as well. All right. So the rule of thumb, or I say is do not close your credit cards because if you close your credit card, you won't lose the history. You just won't gain any more history. Okay. And you want to gain more history. Mix of credit, 10%. Mix of credit just mean at least one revolving, like a credit card. Store department card is revolving, same thing, and a installment loan. Installment loan, of course, like an auto loan is an installment loan, a student loan is an installment loan, a mortgage would be an installment loan. So that's, as long as you have one of each, you have this 10%. And then last is inquiries. Inquiries, these are hard inquiries. Some financial institution checking your credit. Okay, not you checking credit. All right, so credit score components. Okay, so past delinquencies, debt ratio. So remember, past delinquencies, that 35%. This is just breaking it down again. Debt ratio, that 30%. Average age of credit file, 15%. Mixed credit, 10%. Inquiries, 10%. Boom, boom, boom. There you go. There's the chart. Memorize it. That's the breakdown. I will send you a recording. I will send you this recording as well. This is recorded, and I'll send you the one we did last time as well. I'll send everybody up registered. All right. So again, this is the breakdown. All right. So again, you don't want more than, my rule of thumb, that we see, I've seen charts from FICO and all that is no more than 5 hard inquiries in 1 year. Okay. If you have more than 5, I mean, really don't want to, the least the better, but no more than 5. All right. Mortgages, student loans, auto, 30 days. Shop around all you want in 30 days. And then only one counts against you. Okay. So, you go today. So today 30, and go shopping around for the best auto rates, have your credit checked 100 times, only one affects you. On the 31st day, you get it checked again, well, that one counts against you now for another 30-day window, but that one counts against you too. Give it. Credit card 1 for 1. Every time you get your credit check from a credit card company, that affects you in the inquiry section. 3 major credit bureaus, Equifax, Experian, TransUnion. Why do you have different credit scores? Because they may not report the same things, and they might use a different FICO credit scoring model than, whatever place you went to. So, you might go over here and get your Equifax, pull through Equifax for all 3 credit bureaus on our FICO credit score, and you might go to Equifax site that offers credit monitoring and get them all 3 pulled. And for FICO credit score, they might use FICO 8 and they might use FICO 9. For instance. All right, closing. Okay, here's your test. This is your test. All right. So closing my unused credit cards will improve my FICO credit scores. Yes or no? Let's see if I can get the chat here. All right, type in yes or no. Closing my unused credit cards will improve my FICO credit score. Come on, Mohammed. Gotta type in or unmute yourself. I can unmute you if you want. Let's see. All right, Mohammed, you're unmuted. Say yes or no. True or false? True or false, Mohammed? Okay, I guess you're not listening. All right, closing my unused credit cards will improve my FICO credit scores. And let's see if I got this right. False. Okay. So if you're not gonna, it won't improve your credit scores, because you're not using it. It's just not gonna, it's not gonna hurt your credit score. Well, it could hurt your credit scores. So the reason it would hurt your credit score, so if you got a credit card, $10,000 limit, no balance, another one for $5,000 limit and a $5,000 balance, so it's maxed out, right? So that's 100% usage, that's 0% usage. Put them together, what do you got? So you got now 5 plus the 10 is 15 limit with a $5,000 balance. So you got 33%, right? Well, if you close a $10,000 credit card, well, you don't have that usage anymore. And this one's already 5,000 maxed out. Now your overall is 100%. So it could hurt your credit scores. All right. Let's see. My FICO credit scores should be the same with all 3 credit bureaus. True or false? True or false? False. Because things might be different with one credit bureau versus another credit bureau. Remember, it's all volunteer. So you might have something on one credit bureau that's not with the other. You might go somewhere and they might check with one credit bureau pulling your credit. And so you got hard inquiry on that, but not the other credit bureaus. So that could be different, so different information or different credit scoring models or versions of the credit scoring system. All right, I get this one sometimes. When I get married, my credit report is merged with my spouse. So when you get married, your credit report is not merged with your spouse. Okay, your credit report is your credit report, and the other person's credit report is their credit report. So the only time it's never going to merge. The only time you might see the same things on each of the credit reports, if you're looking at hers and his, or hers and her, whatever, nowadays, is if you do a joint account, like you go buy a house together and you both on the mortgage. Okay, so both of you are going to see the same account, or because you both signed for the mortgage. Not to say you both have to be on the mortgage, you could just keep it on one person's name. Same thing with credit card, you both sign together. Or if somebody adds as one person as an authorized user, that's what we always suggest, is not for married people to have joint accounts. So as joint accounts, if something happens, divorce 50% in the United States, or something happens financially, to whatever, then it could eat, one person's credit could be good at least, and the other person could be bad because of the financial hardship, maybe. So I say don't get joint accounts, add one person, get your own, and then add, if you want the other person to use the account, add them as an authorized user. Simple as that. And then if something happens to the account and it's reported onto their credit, well, you just remove them as an authorized user. That account on their credit it'll show terminated, and then it's no longer counted in the credit scores anymore. So even if it defaulted, it doesn't matter, it's terminated, the credit scoring system skips it. All right, ooh, there you go. Checking my own credit score will create an inquiry at the credit bureau and will lower my score. True or false? Okay, so part of it's true and part of it's false. So checking my own credit score will create an inquiry at the credit bureaus. That's true. It will create an inquiry. It's called a soft inquiry, right? So, but it will not lower your credit score. Soft inquiries do not lower your credit scores. You got hard inquiries. That's somebody else, credit card company checking your credits, for instance, which lowers your credit score. Soft inquiries, that's you checking your credit score, own credit score, such as Credit Karma or whatever online. And you have promotional inquiries. That's where you get stuff in the mail says you've been pre-approved for this credit card or this loan or whatever. Well, they went to the credit bureaus, bought your information, and that's why you received that in the mail. All right, so that's promotional inquiry. That doesn't affect your credit score either. And if you do car insurance, looking for car insurances or any other insurances, and they check your credit, that does not affect your credit score either. Okay, that's a different category. All right, so faults. Checking your credit score does not lower your credit score. All right, check your own credit score. All right, so my annual house income is a part of the calculation of my credit score, FICO credit score. Again, false, because FICO does not know what your annual income is. Okay, so they don't go to the IRS and say, oh, what did you know, John report last year or whatever. So that's not calculated. All right, that's it as far as the credit scoring system. Questions, any questions? Questions? You can hear me all right. So it's pretty easy. You are muted. And Mohammed, you been hearing me this whole time? Oh man, so like, I hope I didn't record it. All right, so anyway, that is the end of the meeting. I hope I didn't mute myself this whole time.